them as quickly as possible, and there's news out, and you can see the candles are spiking. Let me just set this up. And I was taking care of some emails. I didn't check the news reports today. Okay, so Tony is saying no fault of the training, just him needing to see things or practice. Okay, well, one of the things now Mike is saying, similarly, I see you find them, but I have problems finding the right setups live on my charts. Uh, okay, yeah, I see Tony, your comment above. All right, so we'll touch on a couple of the basic concepts just to really be clear about them. Now, these two charts happen to be 15-minute charts, but there was a tradable price trap on both of them. And let's start with the euro dollar, and I'll just go over the price trap in general, just to make sure we cover everything. Oh, I also wanted you to see that Sunday, Monday, we had a huge wedge here that played out. If you remember our lesson on wedges, when we closed outside of the wedge here, price moved the distance equal to the back of the wedge, which was 13 pips. And if we look at our entry here, it gave us 22 pips. And we'll touch on that again also. But for now, let's take a look at this price trap situation here. If you remember, there are four aspects of price action. All right. We have the downtrend, we have the uptrend, we have consolidation, as in here, sideways market, and we have, and here's another sideways market, and we have what I like to call an instant reversal, and that's pretty much what this is right now. This one candle is going to turn this market 180 degrees on its head. All right. So those are the four building blocks: the uptrend, the downtrend, consolidation, and an instant reversal. Now, there are a couple of very repeatable, very reliable patterns that you can look at and take advantage of once you understand how they work. And the first of those that I want to touch on is the price trap here, which we covered again last week. I may need to change the color of this box. Now, there's a news event. It's 8:30, so that's what's creating this huge candle here. But for those guys guys and girls that trade news, this was also, very tradable if you were to adopt the price trap scenario to it. All right. So what a price trap is a single candle that is, well, there is a news event somewhere, Bull Hamster. It may not be on Forex Factory, but if you go to Dukascopy, you may see something. Or there may be a talking head out there, but this is clearly a news candle because this one candle took out so far all of this price movement. And that's usually some dramatic event somewhere. So yeah, as I said, it may not show up on Forex Factory, but there is something going on. All right, but I want to come back to the price traps. If there aren't any other comments, I'm just checking the comments, and Dukascopy. I'll touch on that later, Jose. All right. So what a price trap is a candle, and a price trap is one of several forms of market consolidation. A price trap is one of several forms of market consolidation. All right. And remember, consolidating market is one of the four building blocks of price action. So in this particular case, here we have a candle followed by two candles that could not close above this high and could not close below this low. For whatever reason, all of the price action in the euro dollar, okay, and this includes every trader in the world, every bank, every institution, every retail guy, every hedge fund, all of them collectively could not push the market strong in a single direction with enough energy to close above this high, nor could they push the market down with enough energy to close below this low. Okay, and these two candles were evidence of that. Okay, so when we see that, what we like to do is to mark the high and mark the low, and we can use that as a breakout point. All right, and we would be looking to break out of this channel, and we'd also be looking for a take profit on the trade of twice the width of the channel minimum. So in this case, it's a 15-minute chart. It may not be a big channel. It's what, like 4-pip channel, nothing spectacular. But as a scalp, you could certainly come in here and grab a few pips on the breakout of this channel. All right, does everyone see that? Where we had this one candle followed by two. This is a 3-candle formation. You need all 3 candles in order to do this. So Mike, to answer your question, seeing it in real time, that this is something that's quite easy to see in real time, because you need to have these 3 candles all closed, showing us this setup. Any so Michael is asking me, don't we have to wait for the current breaking candle to close? Yes and no, Mike. It depends on how you want to trade the breakout. Okay. On EAH4, okay, Daryl is saying that there's a beautiful price trap on the Euro Aussie H4 from earlier today, and we'll take a look at that. Okay, I want to touch on these traps because in the emails I received and some Skype information I received, there was still a bit of confusion on that. All right, so as I mentioned, we need this 3-candle setup, and we need all 3 of these candles to be closed. We don't want a candle that's in motion. Okay. Also note how far down this candle went, and look how far it has pushed back. So by the time this candle closes, this candle could close inside this price trap, or it could close all the way down here, a huge bearish candle. All right. Now, there are a couple of ways to trade this breakout. Under normal circumstances, if you wanted to do all of your trading on the chart where you found the price trap, we would wait for a close, or the conservative entry would be to wait for a close below the low of the price trap on the assumption that we're going short. All right. That's one of the conservative entries. To enter at the close of this candle, we will enter at the open of the next candle short. All right. The aggressive entry would be to go short X number of pips below this candle, even though, I'm sorry, X number of pips below this low, even though this candle hasn't finished yet. That's a very aggressive entry. Okay. The third way we can enter this, the third way we can enter this is by using what I like to call a sniper setup. All right, so before I leave here, does anyone have any kind of issue or problem understanding the 3-candle setup that you need for a price trap? Now, keep in mind, you must have these 3 candles working in conjunction with each other. You have your master candle or your trapping candle, and then you have, and it's followed by 2 candles that can't close. And again, the operative word is close above that high or close below that low. Now, once you have these 2, this price trap could go 40 candles sideways. All right, so understand that this is not just 3 candles only. This can go on for a long, long time, the sideways market. All right. but we do need these three. So it's an easy pattern to recognize and an easy pattern to trade, and it can be quite profitable. Your take profits are already built into the size of the box. Your stop losses are going to be minimal. In most cases, your stop loss will be the back of the box. So if we go short here, our stop loss goes right above this candle high. And depending on your money management, some people would want to place their stop above this high plus the spread. Okay, so that would be their stop. All right, take profit, as I mentioned, would be twice the width of the box on minimum. All right, so in this case, and I'll just draw the line here, and then we can also take a look at the trade Daryl pointed out. So this would be 1 times the width of the box. This would be twice the width of the box, and this would be our take profit. So aggressive traders who would have entered a couple of ticks below this low would have been in profit already on this trade. More conservative traders would have entered this trade at the open of this candle. Now that we have this candle having closed below the trap. All right, so they would enter at the open of this, and I'll move this over here. And then I'll move this down here, and they would be looking for a take profit down here. All right. Are there any questions on that aspect of it so far? Again, the aggressive trader would enter a few pips below this low, and I only suggest being aggressive when you have chart-based evidence, and I'm going to say this a few times. I would go short here aggressively if I had chart-based evidence that the market wanted to go short. Okay, this is called a price trap, Jose. Jose is asking, what is the name of the box again? And I'm repeating the questions because I realize that you can't see the questions in the videos. Okay. I just want to roll back up. Now Sean is saying for a price trap, 2 following candles cannot close beyond the body and wick of the first candle. No, Sean, that's not the exact definition. Price trap is a 2 candles that cannot close above the high or close below the low of that initial candle that started it. Okay, you cannot close above the high, and you can't close below the low. It's very, very clear and very, very simple. And by the end of the week, I will have a few things written out with the rules on it. All right, I'm in the process of putting some documents together that'll make it easier for you to have something to work with. All right, so I want to be very clear about that. It's a candle that can, 2 candles that can't close above the high of the previous candle or close below the low. Once you have those 2, you have a price trap. Now the trap can go on forever. And the longer it goes sideways, generally the stronger the breakout is going to be, because no one makes money in here in this trap. And this is a money-driven market. It can either be greed or fear that can push you to pull the trigger, but this market is clearly money-driven. All right? So, are we clear on that? We need 3 candles to work together. All 3 candles have to work in unison to present ourselves with a price trap, or a master candle, which is another name for it, or a trapping candle. And we have the 3 different entries. And we'll get into the sniper entry in a minute. I first just want to point this out. Okay, if you're going to take the entire trade on the 15-minute chart, your entry can be a couple of ticks or X number of ticks below the low. Your stop loss will be at the high, high of the box plus the spread. and then your take profit, you'd be looking at twice the width of the box. So on this particular aggressive entry, as you can see, you clearly would have made twice the width of the box, which was about down to here. I'm not too worried about the number of pips because this will work on any time frame. It's more important that you understand the thinking and the money management behind it. Okay? In another trade, you would enter a conservative entry would be at the close of this candle that closed below the box. At the close of this candle, you could enter short. Okay? The extremely conservative entry and the absolute safest entry would be to take a trade one tick below the low of the candle that broke the box. But in this case, that's not a high probability trade. Now, B is asking, is this trade setup suitable for all pairs? Yes, it is. It's suitable for all pairs, suitable for all time frames. All right. I particularly like it on the higher time frames because I like to scalp in. Okay. So as you can see, an entry at the close of this candle would have given us a profit of at least one times the width of the box already. Okay. And hopefully this candle may make it to the bottom of the box, or the next couple of candles may make it to the bottom here to give us the full take profit. All right. Now, these rules pertain to trading this on the initial chart, the 15-minute chart, or the 1-hour chart, or the daily chart. All right. B is typing a question. And B, if you could just type your full name. Okay, he withdrew the question. All right. Now, the other way to enter this trade, which is aggressive in one respect, but offers some a bit of a conservative approach, would be to take this trade as a sniper trade. Okay. Now, B is saying, okay, thanks, Lou. You mean set up on a higher time frame and entry on a lower? Oh, it's Brian. Okay. Thank you, Brian. Yeah, well, that's what a sniper trade is, Brian, is when you see the setup on a higher time frame, and then you go down to a lower time frame to take the trade with much, much less risk. All right. So we'll take a look at this one particular trade as a sniper trade. We have our low in place, which is right here. All right. My bias on this is short, and I'll discuss the bias in a minute. So what I want to do then, I want to find this price point on a lower time frame. So now that I have my low in place here, I will mark this candle. And where this vertical line and horizontal line meet, it creates a crosshair. And as you can see, have we taken the moderately conservative entry on this trade, this would have produced twice the width of the box. And again, it's a 15-minute time frame. There's not a lot of pips, but I want you to see the concept. The concept works. And I'm glad this happened in a live market. So you can see that it does work. It's very, very reliable. All right. But now let's look for this sniper trade here. So now I'm going to go down to a I'm going to go to a 1-minute chart, and I'm going to look for a valid trade setup underneath this low, this blue line. Does everyone understand that? Mike Schumann, do you understand that? I see this candle is trying to break this low here. So I'm going to go to a lower time frame, and I want to try to enter this trade with a smaller risk on a lower time frame. So let's go down to a 1-minute chart, and I want to look for that crosshair. Okay, now everything's moving here. So this is our crosshair right here. Does everybody see that? I need to change this, make this on the foreground. Let me just see something here. Um, this is on the background, and you guys understand what I'm trying to do. I want to get the, I'll have to play with that later. But this trend line I drew here is under the candle, and I actually want it to show above the candle, but I'll get to that later. All right, so what I'm looking at, or what I'm looking for on the lower time frame is an entry below this crosshair right here. And let me see if I can just put another line up here. Oh, okay, there we go. Ah. But does everyone see this? Is this clear enough? I'm on a lower time frame. I want to take the same trade, but I would like to take that trade with a much, much smaller risk. All right. So in this case, what I'm looking for, or what is apparent on this particular trade, would be these pullback candles. I've got a series of pullback candles here. And now when I close below this pullback, I can enter at the open of this candle. This is going to drive me crazy here. I was doing something else this week. Foreground is white. Okay, there's my crosshair. Now, I just want to check the questions. Can you draw a trend line? Oh, yeah, I just drew a trend line. And Mike, I know this is not a dead letter perfect trend line. I'm just, let me fix this because Mike will give me a hard time about this. Okay, that's, now these are your pullback candles. And for those that are new in the room, I'll touch on pullback candles in a second. Untick chart on foreground. Yeah. Thank you. I knew it was there somewhere. All right, thank you, Pip3 for that. Okay, so I'm using these pullback candles as a method of trade entry, okay? And once we break this trend line, my basic entry would be at an open of this candle after the trend line break. The conservative entry would be one tick below the low of the candle that broke the trend line. My stop, and we'll take each entry, my stop at the conservative entry or the moderate entry is here, and my stop would go above this high. Okay, so in this case, I have a 3-pip stop. Okay, and I'm still looking at, I think it was for an 18-pip take profit. So I've knocked my risk down dramatically just by going to the lower time frame and looking for the same trade on the lower time frame. Does everyone see that? Oh, and that's why I call it a sniper, because I create this crosshair. And I want all of the details of the new trade to take place below this line. Okay? Now keep in mind with a 3-pip stop, this thing could run 50 or 60 pips. We didn't do a price projection yet. But what you want to do is to keep your risk at a minimum and keep your take profit at a maximum. Always. Some of the best trading systems in the world used by a lot of institutions sometimes have 60% loss rates. Okay? But they're risking a tiny amount and they're literally shooting for the moon. So they can afford, to take 6, 7, 8 losses in a row if necessary. If they're, accurate about their direction and if they're committed to that trade, they will eventually become profitable on the trade with minimal loss, and they'll always be at 1-to-1 or higher in their risk reward. All right. Are there any questions on what I've gone over so far? Now, we have a new person here, Jose. And Hot Curry, you can lose 70% of your trades and make money and I'll give you a very simple example with numbers that in this market could be fairly realistic. Let's assume a basket of 10 trades, okay? And let's assume on each trade our take profit is 30 pips. Uh, okay, our take profit is 30 pips. All right, our stop loss is 10 pips. All right, so now we have a 30 pip take profit and a 10 pip stop. That's 3-to-1 risk reward. Is that reasonable in this market? That those are not off the chart, way out of whack numbers that really couldn't happen. Do you guys agree with that? That you could look for trades that have 10 pip stops and the possibility of a 30 pip take profit. Just want to make sure that you guys don't think these are, just blown out of the water numbers. And I'm just waiting for the rest of you guys to type in because I don't want to move on until I'm sure you guys get the idea. Thank you, Tony. Thank you, Chris. Thank you, Brishu. Okay, Rob, thanks. Phil919, Brian. Okay, so let's assume that you lose the first 7 trades, okay, under the scenario. So you end up with 7 times 10 is all right. So 7 times 10 equals a 70 pip total loss. All right. Everyone see that? We're talking 10 trades. Now the next 3 trades are winners. All right. So in this case, we end up with okay, in this case we end up with oh, I'm sorry. Shoot. I did it wrong. In this case we end up with 3 winning trades of 30 pips each. And why didn't that come down here to help me? Okay, so now we have 3 winning trades at 30 pips equals 90 pips. Okay, so we lost 70 but made 90, so we end up now plus 20. So I want you to really understand that we will end up overall plus 20 in profit. All right, and the name of the game is to end the day profitably. So I want you to see that with realistic numbers using 3-to-1 risk reward. I'm not talking pie in the sky. I'm not talking anything bizarre or something that couldn't be accomplished. All right, you could take 7 shots at that, 6 shots at it. Okay, and then on the next couple of trades, you could certainly come out ahead. So I want you to really see that. Now, a lot of what we do has a lot of what we're going to learn has a much, much higher success rate than 7 out of 10 losers. But I want you to just understand that if you keep your losses to a minimum and keep your projected take profits realistic and at a maximum, you can do very, very well in spite of a series of trades that may not work out. And any trader that's been in this game for a long time knows that you will have those days, you will have those periods when you will have 2, 3, 4 trades in a row, possibly more, go against you. All right? So keep that in mind. Now, I do want to explain my language a little bit. What I uncovered in my brain, for me some time ago, was to not tie my self-esteem to the outcome of a trade. It took me a long time to get that. All right. And if I had a trade, and I'm going to use the old way I used to say it, if the market stopped me out, I would take it personally. Okay. If the market went against me, I would get mad at the market. Now, that verbiage, that kind of language is so unrealistic and just totally out of touch with reality that it's actually harmful. But it unfortunately is the language most traders use. Okay? The market does not know you personally. The market does not even know you exist. You could virtually be a robot sitting there pulling the trigger. The market doesn't know and it doesn't care. All right? The market's going to move on people making decisions to buy and sell, and it's going to move according to those decisions, whether I like the decisions or not. And I mentioned this last week, and I will mention it again. Two very important things to keep in mind. One, the market never, never, never moves in the wrong direction. The market, the market always moves in the right direction at all times. Where many traders have an issue is that it may not move in the direction, that the market may not move in the direction that they want it to move. And this is where all the static starts. This is where all the conspiracy theories start. All right? The market's never wrong. So it dawned on me that if the market is never wrong, then all I need to do is pay attention to what the market is telling me, and I can be in that, I can be in tune with the market. Okay? And if a trade doesn't work out, it has nothing to do with me personally because the market doesn't know me. This is a very, very important thing to wrap your head around. And what I began doing was using different language to explain some of the things I saw happening on the charts. And it helped me to better understand and handle what was happening on the charts. So now, if I place a trade, and in the old language, I would say if the trade stopped me out, I don't say that anymore. What I say is, I say, my terminology for the most part is that the trade didn't work out. It wasn't me. The trade didn't work out. And by saying, okay, I had a trade that didn't work out, it takes the me part of it out of the equation. I'm not attaching my sense of value to the outcome of a single trade. I'm not attaching my sense of well-being, my sense of, oh, I'm smart, or oh, I'm dumb. I'm not attaching any of that to the market. I went to the marketplace. I saw a trade. Now I'm going to go back to my melons again. And I picked up the melon and looked at it and did the test. And okay, this melon looks like it's worth my money. Okay. So if I place a trade, I'm buying a trade. If that trade didn't work out, it's the trade's fault. It's not my fault. You follow me? That makes me less afraid of the market. It takes that sense of panic and fear out of the market for me. And it also makes it easy for me to pull the trigger on the next trade because it wasn't me. It was the market. The market's never wrong. So this is something very, very important. Try to change your language around what happens in the market, and try to not attach your self-esteem to the event or the outcome of a given trade, because it has basically nothing to do with you. You're out of the equation. Once you pull that trigger and put the trade on, it's now up to the market. Okay? And you can really end up beating yourself up doing that, tying your self-esteem to the outcome of a trade. All right? Yeah, Michael is saying that he seems to read the market wrong, and that could very well be. Rob is saying it's just as dangerous when you win. Yeah, when you have a series of winning trades in a row, you need to be careful that you don't take the assumption, oh, I've got this figured out. I am the man. I am the bomb. Oh, I've got this market, conquered, because that will breed a sense of overconfidence. And what will happen when you're overconfident, you won't wait for your complete trade signal to set up, because you'll start assuming, oh, I know that's going to be a price trap. Let me enter now instead of waiting the extra 5 minutes. Or I know that this is going to be a wedge breakout. Let me enter now instead of waiting for the full thing to unfold. And it's that sense of overconfidence can be just as dangerous as beating yourself up. So that was an excellent point, Rob. I want to thank you for bringing that up. All right. Now, to touch on Michael's situation, when Mike says he seems to read the market wrong, learning to read the market is very much like learning a new language. And it's important to simply take the time to learn the verbs, learn, the nouns, learn how the different things go together, and don't expect it to really become an instant thing that you grasp. Some people grasp certain parts of the market easier than others. Okay? So take your time and give yourself time to learn. Remember, this is a marathon. This is not a sprint. All right? So don't tie your self-esteem to the outcome of a single trade, because the market doesn't know you. There's no guy at the brokerage sitting there looking at your specific account trying to grab your 10 pip stop. They couldn't hire enough people to cover all the retail traders in the world. And then when you look, the vast majority of retail traders are trading mini lots, and some of them micro lots. So they're going to pay a guy $40,000, $50,000 a year to look at your account and go after your 3 or 4 mini lots or your 2 or 3 standard lots. It just mathematically doesn't make sense to hire someone to do that. So I want you to understand, don't get wrapped up in that whole thing of some great demon in the sky hunting your stops. They don't even know that you exist. All right? What happens with this market? In most cases, it's one big dog going after another big dog. We just happen to be in their way sometimes, and we get run over. Or the market, runs, through our price levels. Okay, so keep that in mind. Don't tie your self-esteem to the outcome of any one trade. If you buy a trade and that trade doesn't perform properly, the stop loss is your mechanism to fire that trade. So do you understand that? Because you're hiring these pips as employees. You're sending them out into the Forex world. Okay, I'm hiring you 10 pips as a stop loss. I want you guys to go out into the Forex world and bring me back 30. If they fail, that stop loss is your way of firing them. So don't get your own brain too tied up in the any number of successes or losses. All right. And when we get into money management and trading psychology, and that's going to be about 3 days straight, the money management and trading psychology, it will be very little chart work except to show the psychology on the chart. All right. But it's extremely important, and it's so often overlooked that it just kills traders. Okay. So let's get back to the chart. Any questions on this, what we did and how we did it? I'm going to go back to the 15 and walk it through one more time. Oh, I got to get rid of some of this stuff on the chart. Oop. Okay, I have to put this line back. I have to wait for a tick to come up. Okay, so as you can see, based on this price trap, had we wanted to enter this trade short, my bias is short, and that's the next thing I'm going to go over with it, okay? My bias here was short because I had chart-based evidence. And I'm going to say that again. I had chart-based evidence that the market was looking to go short. Okay, this is not something where I think or I feel or I assume. I'm looking for the language of the chart to tell me. All right. Next week, we'll be getting into individual candle DNA. And once you begin looking at individual candle DNA, that will help you pull the market apart a bit easier. All right. So for those traders that wanted to take a conservative entry, the conservative entry would have been one tick. I'm sorry. At the close of this candle, and this candle closed outside of our trap, we would enter short at the next candle. Our stop loss would be the back of the box. In this case, it's an 11 pip stop, which is too much based on the size of the box. You don't want the stop to be dramatically larger than the size of the box. All right. But I'm skipping around a bit. Let me go back and start again. At the close of this candle, we want to enter at the open of the next candle. Our profit target is twice the width of the box. Okay. So, and I'll again do this again. And I know this may seem boring to some of you because you've seen it a few times. But I want to go over this again for anyone here that's really not clear. That's 1 times the width of the box. This is 2 times the width of the box. So an entry at the close of this candle would have certainly given us our take profit. And remember, I said it's 2 times the width of the box at minimum. All right. You could certainly split your trade once you got, 1 times the box, moved your stop loss up to your entry point, and then let the rest of it run. Okay. The very conservative way of entering this trade would be to enter 1 tick below the low of the candle that broke the box. And in this case, had we done that, we still would have made twice the box in profit. All right. The aggressive way, or another form of a conservative way of entering the trade, would be to use this candle as it's starting to break this box as a sniper point, where we mark this candle and we go down to a smaller time frame, and we're looking for a complete entry below this low. So I'm going to go back to the 1 minute time frame, and I'm looking for an entry below this point. And one method of entering this trade would have been on these pullback candles. We would pop a trend line in here, and we would look to break this trend line, take the trade in the new direction, and with our stop right above the last candle that broke the trend line. Okay, you guys are typing in questions pretty quickly. Let me just go back and look at them. So Jay is saying, how do we know when we should pull out of this trade? Well, it's right there. It's the width of the 2 times the box. And then Jay is saying, Lou, how do we know when we should pull out of this trade? I'll touch on that in a second. But the first and simplest, because each thing I teach has everything built in. Your take profit's built in, your stop loss is built in, your money management is built in. So now you can always tweak it, you can always make adjustments. But in the beginning, when you're learning, it's better to have simple, reliable, measurable rules to get you to doing the right thing over and over and over. Okay? So now this was one. I'm going to show you 3 or 4 ways to get into this trade on a 1 minute chart. But the key here is that you want all of the candles involved in making the trade to have occurred under this line. If these candles are still dancing back and forward above this line, it's better to wait until you get a full signal under the line, under this low. Okay, Mike Schumann is, how do I seem to be too late or unsure of just, and I'm trying to read this, Mike. Okay, Mike is saying, Uh, these are coming in very, very quick. I ask you guys just to hold off on the typing for a second. Mike is somehow I seem to be too late or unsure of just what to do at the time that I am looking to enter a trade. Mike, the way you overcome that is to get a pencil and a blank piece of paper. And when you see a trade set up, first take the trade based on what you see on the chart. And then on that blank piece of paper, write down what you saw. So you can go back to that trade later. If you come back to that trade a week later and you want to know why in the world did I pull the trigger there, you have documentation in front of you on that blank piece of paper. Well, I got into this trade because I saw a trend line break, or I saw this, or I saw that. That's what you do on a demo account, Mike. Okay? You pull the trigger and then write down why you pulled the trigger so you have a record to come back to. And this is very, very important. The record is in your own handwriting. And I won't get into the neuropsychological aspects of learning, but if it's in your own handwriting, it will burn into your brain a hell of a lot faster than anything I could tell you or any book I could stick under your nose. All right? So that's what you do. You pull the trigger. If you believe it's a setup, pull the trigger, write down what you saw. Then we can come back and look at at your reasoning behind the trade, Mike. Okay? So that's the first thing. Pull the trigger, then write down what you saw. Now, Terry is asking, could we take another entry on the pullback? Yes, we could, Terry. I'll touch on that. But is it me when I am looking at the chart myself? But it is me when I am looking at the chart myself. Well, Mike, it's always going to be you when you're looking at the chart yourself. But at some point, you have to make a decision, pull the trigger, and then document the why. Believe me, if you do this, it will move you forward at light speed. Just document what you saw. Don't worry about trying to figure out every nuance at the moment. If you see the rules clearly in front of you, pull the trigger, then write it down. All right. So now I'm going to move on, Mike, because I want to touch on the other ways of getting into this trade. All right. There were 3 different ways to get into this trade based on what I've been teaching. I want you to notice right here how this whole conversation got started this morning. This is a price trap. You'll notice this candle, the high and the low, and notice the next 2 candles could not close above that high or below this low. You could certainly use that as a method for getting into this trade. And again, we have the 3 candles working in unison to create the price trap. Do you guys see that? Jay, we'll get into how much profit you should be satisfied with in a moment. And that's a personal thing. Okay, and it also goes into what your goal structure is. And I'll touch on goal structure just briefly, just as a preface to when we talk about money management. But what I want you to see is our aim is to get into a trade below this low. And remember, this blue line is the low of the 15-minute trap candle. Does everybody understand that? Just give me a yes or no if you do. All right. Does everyone understand that we're looking to get into a trade at this low, which is the 15-minute trap candle? I have to bring the okay, and I'll come back to your question as for how much is enough. I pull the trigger with no problem, but the why becomes a mess. Well, then don't pull the trigger, Mike. Mike is saying he pulls the trigger with no problem, but the why becomes a mess. Okay, the why should never be a mess because you shouldn't pull the trigger until all your checklist boxes are ticked off. Do you understand that? You make a checklist. Do I have this? Yes. Do I have that? Yes. Do I have that? Yes. If you don't have that, don't pull the trigger. It's very, very simple. How do we put the blue line there? Jay, which Jay is this? I don't know. Could you type your full name? You said, why do we put the blue line on the very top? I mean, what makes me, and then it's cut off. I want to understand what blue, oh, J101, okay. Oh, did you get my email? Okay, cool. And okay, are you asking me why am I putting this blue line up here, Jay? Is this the blue line you're speaking of? On top, yeah, but which on top, Jay? Are you talking about this line? This line? And just give me a yes or no if that's not the line you're talking about. The bigger blue line. You're talking about this line, Jay. Okay, and your question is why did I put it up there? How did I put it up there? Now, are you talking about how to use the platform or what my reasoning was for putting the line here? Is it how to use the platform, the reason? Okay, I'm going to go back to the 15-minute chart again, Jay. And you guys, just forgive me. Let me go through this because I want to make sure that I answer his question. If you remember, Jay, you see this candle right here. You see this candle, Jay. Okay? You'll notice that the next two candles could not close above this high and could not close below that low. Do you see that, Jay? Okay. So this becomes my price trap. I mark the high of the trap and I mark the low of the trap. Now, on this charting platform, if I go to a lower time frame, these two lines will follow me to the lower time frame. Okay? So when I go down to the 1 minute chart, both of those lines will follow me down. You see that? These are the two lines from the 15-minute chart, Jay. Do you have that, Jay? Okay. So these are the two lines from the 15-minute chart. They simply followed me to the 1 minute. All right. So now I'm going to move forward now. So now this line is the low of the price trap on the 15-minute chart. Yeah, Mike says you see too many price traps and seem to take the wrong trades. I'll touch on that in a minute, Mike, because I mentioned several times all price traps are not tradable. And I also mentioned the real estate rule, location, location, location. Okay, it's where the price trap occurs is what gives it its higher probability. So now the next thing I'm talking about is how can I get into a trade short below this line, and how can I get into a trade with a high probability of moving in my favor? The first thing I touched on, moving too quick. First thing I touched on, I'm going to walk through it again, was the trend line break. Now, here we have pullback candles. How do we know we have a pullback candle? Anyone that was here for the last few lessons? Okay, Pip Thief, you got it. These are pullback candles because this is one instance where the low of this candle is higher than the previous candle. That gives me an indication that in this downtrend, we may have a pullback occurring because now these lows are not getting lower anymore. See where we have a low, then a low, then another low, then another low, and all of a sudden the low of this candle is not lower than this one. That's an indication that we could be in the midst of a pullback. And once we have these two candles, and remember, I'm trying to teach you guys how to spot this stuff quickly. Okay? Once we have these two candles, you can draw a trend line. Okay? And then you can adjust the trend line as price moves on. You will make an adjustment to it because, one wick may come down a little bit more than another one. The other wick may come up a little bit shorter. But what you're looking for is a break of the trend line now. So on the break of this trend line, we can enter short at the open of the next candle is one method. We can enter short one tick below the low of the candle that broke the trend line. is another method with our stop loss at this high. Are there any questions there? How now? Jay is asking, how do we know this pullback is continuous going high? I think you're asking me is how do you know how far the pullback will go? Is that what you're getting at, Jay? Right. Nobody knows. It's impossible to know. We have guidelines that we could use, but nobody knows where the very next tick is going to go in this market. Nobody knows where the very next pip is going to go. We have guidelines and we have probabilities that we can look at. Okay? Generally, on a pullback, you're looking for at least 2 to 3 candles. So that's one thing you can kind of get your mind wrapped around. When a pullback starts, expect it to be 2 or 3 candles in length at least. And then you can adjust your trend line accordingly until a candle breaks the trend line. All right? And the candle that breaks the trend line is the opposite of the other candles above the trend line. Do you understand that, Jay? All right, George is asking a question. George is saying, can we trap the trap? And he's asking me, can we place 2 orders, one above and one below the target? 2 orders, one above and one below the range. In this particular instance, George, what you want to do is keep your risk at a minimum. And if you place an order 1 pip above and 1 pip below, what would happen if it closed above and then came right back down and then closed below? You could end up getting stopped out on both sides. Okay? On that type of thing, it can be a bit more risky. It's better to take the small loss in the direction that you've predetermined rather than trying to get cute. Okay, you can get as cute as you want. Okay, but my job here is to show you how to make money. My job is not to show you cute. Okay, that's what puppies are for. You know, and flowers in the spring and all that. All that's for cute. This is about making money. All right, George? And making money safely. So, one method of getting into this trade is with the trend line break. And again, this is crucial. All of the candles that went into the pullback, all of them occurred under this low from the 15-minute chart. Jay, do you see that? All of the candles in that entry happened below the chart. So let's get rid of this trend line now. The other way we could have entered this trade is with this price trap. And remember I said what I'm teaching you is fractal. It's the same on every time frame. So here we have our candle, and it's followed by 2 candles. 2 candles that could not close above this high or close below this low. So just as we did on the 15-minute chart, we mark this high and we mark this low. And now we're waiting for a break below that trend line. Our bias is short because we want to take the trade below the low of the 15-minute candle. Am I going too fast? You know, just somebody let me know. And I'll back up and we'll do this one more time because this is important that you know you kind of get this. Because it's very, very simple. Okay? But we tend to overcomplicate things. And unfortunately, most of the, you know, when I study people that have made large amounts of money in the Forex market, some of them work for hedge funds, some of them work for banks and institutions. Their methods at their core are so simple that you simply cannot believe they can make money with it. But that's what makes them profitable, is that they're keeping it simple. So the second way to enter this is by looking for another price trap. All right, and the same rule applies. We will enter here at the we enter at the open of the next candle after a trend line, after the price closes below the trap. Let me say that again. Our moderate entry is to enter this trade at the open of the next candle after a close below the trap. The conservative entry would be to enter a trade one tick below the low of the candle that broke the trap. And if there was an even tinier candle, then in 1 minute, I would put a sniper on this and try to go down there and try to catch it. Now, Jay is saying the candle next opens above would be long. I don't understand that question at all, Jay. The candle next above, he wrote the candle next opens above would be long. Well, yeah, Jay, we already determined that we were going to go short. So if a candle opened above this trap, we would ignore it. And we would look for a short signal. You got me? We only want to trade in the direction of the big boys. And because we can't predict where the next pip is going to go, yeah, you may get some market noise that might close above this price trap on the 1 minute. You got me? But we are looking to go in the direction of the 15-minute candle. So what Jay was asking in essence is if this candle were to open above our trap, what would we do? We would ignore that and we would wait for a new trap or a new signal, but our bias is to go short and short only. Okay? All right, so everyone sees that. We found a price trap on the 1 minute and we can use that to get into the trade. I don't know who's doing that, but sometimes the text box